Yeah, welcome everybody. Today's webinar is a UK property market update. So we're nearly at that halfway point of the year. So I'm going to give you a good sort of sense of where we are in terms of UK property. Bit of background to myself before I hand over to my colleague David for his background. So I've been based with IP Global for 19 years now across mainly Hong Kong and Singapore, where I spent 16 years in the business, and now I'm back in the UK just outside of Cambridge. So, David, how are you?
Hi Grant, good, thank you. I've been with IP Global for 11 years now. Five of those years in Hong Kong, moved back to the UK back in 2018, and now in the UK.
Okay, great. And how do you think the year's going in terms of property in the UK?
Yeah, it's been an interesting year. I think what we've seen is a couple of interest rate cuts, which has definitely helped the market. And I feel what we're seeing in the next 6 to 9 months, with inflation gradually coming down, is we're seeing more interest rate cuts, and yeah, more people who've been sitting on the fence have started to come back into the market. To be
Yeah,
fair.
yeah, no, agreed. No, that's good. So, yeah, we'll cover a fair bit of that in the presentation, and but no, I agree with your sentiment. We've certainly seen that sort of positivity. I mean, just to, first of all, to everyone, a little bit of background to the business. So, IP Global business has been going nearly 20 years now. I've been pretty much since the beginning. We've transacted on 6,000 properties over the years, 3 billion US dollars of property investment, about 2.5 billion pounds, and we've invested in 18 countries. So we've got a lot of experience in terms of property investing. And therefore, we have a good sort of sense of key property markets and what is happening economically and the opportunities that are presented. And actually, we've done most of that investment in the UK. In fact, about 1.5 billion pounds of investment in the UK over 100 residential projects. And residential is really the sort of main thrust of this presentation today. All right, so as I mentioned, yeah, we're nearly at the midpoint of the year. So what have we seen happening? So basically, if we go back to the start of the year, we had effectively a tremendous amount of impetus really from January ahead of the stamp duty window for first-time buyers closing. So in simple terms, there was a reduction in stamp duty for first-time buyers that was going to close out in April of this year. And therefore, what that did with that deadline, it basically stimulated a lot of demand for first-time investors to get into the market. So we saw a big boost in the first-time buyer market until that April deadline. Now that kind of coincided with a interest rate cut and has created a lot of positivity around the market up until April. And I think the sense was that perhaps once April came, there might be a little bit more subdued property market. But actually, we then saw an interest rate cut in May that basically stimulated some further growth into the market. And as an overall sense, we've seen buyer demand up this year quite significantly because of the interest rate cuts, because of the momentum from the first-time buyer engagement. So we've seen buyer demand up, number of sales agreed up, the flow of new property up, and stock of property up. Now, the housing market is such a big, important part of the industry in the UK because it has so many feeders in terms of, people buy houses, they pay stamp duty, they do renovations, they get new furniture, etc. And all of that has stimulus across the economy, which is very, very positive. So after what we have to say has been more of a challenging few years, we see a lot more impetus in the market. And of course, we'll go on to interest rates as we go through this presentation, and I'll share more onto that. But in effect, what we are seeing is the fact that affordability for buying property is increasing as mortgage rates come off, given interest rates have been coming off. And therefore, it's actually starting to make property as cheap in terms of mortgage payments to rental payments. So we may well see a softening of rental inflation as more and more people start to buy property. And therefore, that means in what we always talk about as an undersupplied market, that provides opportunity for capital appreciation. I mean, I see where I live locally, houses coming onto the market, and they're certainly shifting quicker than they were sort of 12, 18 months ago, and that's healthy for the property market. David, anything to
Mm.
add on your side?
Yeah, I think on that, obviously, we're seeing improved economic conditions. The UK was the fastest growing economy in the 3 months, first 3 months of the year in the G7, and therefore the IMF upgraded the latest forecast to 1.2% this year. And I think we're seeing that with the property market. We're seeing anticipation of good capital appreciation this year and the next couple of years. So I think there's going to be a bright future in the next few years for the UK for sure.
Hmm. Yeah, thanks for that, David. Okay, we'll move on to the next slide. Labour's nearly been in power for a year now. Next week actually marks the first anniversary. They set out a goal of 1.5 million homes to be built. They are looking to achieve that through a raft of measures, mainly trying to speed up planning rules and regulations. Um, I think at the time I was quite sort of skeptical, and I think that's kind of like starting to bear fruit now in terms of the reality of where we are with that sort of plan. And I think recently it's kind of been intimated that we'll probably get closer to a million homes built rather than
Mm,
1.5 million over the next few years in the lifetime of the government. Now, there's all sorts of challenges. Yeah, planning rules and regulations. In fairness to the government, they have done a number of good work to sort of look to speed them up. They're looking to try to allow central government to more sort of supersede local planning decisions. And also they're looking to employ more planning officers. However, I think that number across the country is around about 300, and that's by no way is going to be sufficient to really deal with the sort of process of planning applications and to expedite that process. Of course, one of the other challenges is there's more and more rules and regulations around property, ESG, sustainability, etc., energy efficiency, which is all very good and absolutely needed. But of course, it's going to mean that more issues need to be worked through, documentation signed off, etc., before planning applications are processed. So there's a lot of good work being done, but there's a lot of hurdles to overcome, and property is a challenging business. And
mm,
then, of course, you get onto the fact that you have to look at manpower. Property building needs manpower. There is a skills shortage. There's a shortage of plumbers, bricklayers, welders, electricians. Anyone who tries to get a plumber, electrician, etc. It's not easy. It's not easy to get them to come round as soon as possible because they are just not there. The average age of a bricklayer apparently in the UK is 55 years old. And of course, with Brexit, there's less inward migration. So the skills shortage is really a challenge.
mm,
And also, as it mentions there's a shortage of bricks. There's a big brick shortage, which means it's
mm,
just physically not possible at this time to
mm,
build a number of houses. And if you look at the chart on the right, you know, with a target of 300,000 homes a year needed to be built, so 1.5 million over the course of a government, um, the last time that target was met was 1977. So we're talking about, nearly 50 years ago that the last time 300,000 homes
mm,
was built. So it's challenging. As I say, the government's doing a number of good things. It's going to take a lot of work to continue to look to get houses built to the targets that are required
mm,
for the population growth, etc. Of course, this is good for investors because undersupply, tight supply means that capital values, rents will continue to uptick. So it's positive on that side. Um, but I think one of the other points I would make is, of course, government talks about building property. It's not governments actually build property. it's property companies. And there was a survey recently of the top 50 building companies in the UK. Only 1 in 50 said that they would actually get to this target of 1.5 million homes over the next 5 years. So that really does show you the extent of the challenge. So yeah, that's where we are right now in terms of the plan to build the necessary housing. David, I don't know if you want to add anything there, Tom.
Yeah, I think it's worth deep diving a little bit more on that target which Labour put forward, as it was one of their main manifesto points last year and what they won on. I mean, the latest forecast is that we're going to build 200,000 new homes this year, which is, 100,000 homes less compared to what they want to build, 300,000 a year. And OBR recently commented that only 1.3 million homes will be built by the end of this decade, and that's across all of the UK. Labour's pledge actually, interestingly, only applied to England for the 1.5 million. So their forecast for England, the amount of homes being built is 1.1 million, leaving a 400,000 home shortfall, which is the same amount of homes in Milton Keynes, Newcastle, and Plymouth combined. So that just shows you the shortfall which is forecasted by the end of this decade.
Yeah, no, you make some good points there, David. And I think it'll be interesting if we review this in another year, just to really get the granular detail again on what has happened. Because clearly it's not going to get to those targets, and it'll be very interesting to see if those targets have moved at all. I think rather than in terms of more build, I think they're likely to be potentially less. So it will be a
Mm,
very interesting subject to keep our eye on for sure.
agreed.
Next slide, please. All right, so inflation, interest rates, of course, this is a very important subject when we're talking about property. So let's just sort of recap on, the important milestones of inflation. Now, interest rates, um, inflation are closely correlated. If inflation is low, interest rates are low. If inflation is high, interest rates are high. So if you go back to the early 2020, 2021, 2022, inflation and interest rates were very low. Then, of course, post-COVID, when life got back to normal, there were supply chain issues, etc. That caused inflation to increase. And as inflation goes up, to tame inflation, you need to increase interest rates, basically. So effectively, we saw inflation get up to double digit around 2023. We saw interest rates get as high as 5.25. And then we started to see into 2024 inflation start to come off, which enabled then the Bank of England to start to reduce interest rates. So where are we now? So basically, as we sit here at the end of June, we've seen interest rates come down to 4.25%. And that's been possible to do because of the fact that inflation has come off rapidly, albeit over the last few months it's got a bit sticky, given uncertainty in the world, given tariffs, given the fact that we just need to see how all that effectively plays out. We've seen that said, 4 interest rate cuts over the last year. We saw interest rates held last month because of the sort of instability around obviously the Middle East and tariffs and how that's all going to play out. However, things change quickly, and even just in the last couple of weeks, we've seen a survey on manufacturing inflation at the company level, which is showing inflation has started to drop off. We've seen unemployment go up in the UK. Um, we've seen the lowest amount of cars being built actually just revealed today, I think since 1946. So basically, what this is going to lead to, in my opinion, is we're going to see a couple more interest rate cuts by the end of the year, possibly as soon as next one in August at the Bank of England meeting. But clearly there's a lot of sense that interest rates will come off potentially quite significantly over the next number of months. Indeed, Morgan Stanley are talking about 3.25% by the end of this year. And that's very, very positive for people looking to get a mortgage because as interest rates go down from the Bank of England, that feeds through to lower mortgage rates and creates better affordability for people to buy property. And if there's better affordability, more property transactions happen, and that, as I say, it has an impact on prices. The other thing that's very positive is that effectively aside from mortgage rates going down, actual lenders are making it easier to borrow, put simply. In other words, they are reducing their what we call stress tests. Now, in simple terms, what they do is they calculate not only what the interest rate is now, but they work out in terms of individual borrowers could these borrowers still pay their mortgage if interest rates went up, to say 5, 6, 7, 8%, etc. They all have their own criteria. Now, as interest rates are going down and in a downward cycle, they can reduce those stress tests. And therefore, what that means is more people will have the ability to secure a mortgage as they reduce those stress tests. So more people will ultimately be buying property. And again, that will help the market as a whole from a capital appreciation perspective. So, all right, I'll just stop there. Do you want to add anything, David?
Yeah, interestingly, last week when we had the interest rate decision, there was supposed to be the forecast was a 7-2 pause, and actually it was 6-3 pause. So we were relatively close to a potential another cut, and the forecast is that we will likely see another interest rate cut in August, which is obviously good for the market. I mean, there's a lot of different expectations where interest rates will be at the end of this year, end of next year, etc. The IMF forecast a 0.25% every 3 months cut here in the UK. And then you've got banks such as HSBC, UBS forecast interest rates to fall to 3% in 2026. So we are likely to see another 3 or 4 cuts, I would say, by Q1 next year, which, as I say, is good for clients looking for mortgages to purchase property, etc. So um, I think we'll see a cut probably next in the next decision in August.
Yeah, no, I'd absolutely tend to agree with that. It will be interesting to see where rates are by the end of the year. I think 3.25% as a bank rate is quite aggressive.
Mm.
I don't think it'll be that far down. It's possible. But yeah, I think arguably we are going to see those 2 or 3 cuts that is mentioned there. I do think that's realistic. Um, so yeah, okay. So currency side. So yeah, it's certainly been an interesting year in terms of currency for the pound, the GBP as we call it. So if we look at the pound to the USD, for example, and this is particularly relevant for people buying property from overseas, of course. So a weaker pound presents an opportunity. A stronger pound makes it more challenging, albeit relatively speaking, although the pound has started to strengthen, it's still relatively weak in terms of if you look at historically speaking. And what we've started to see is that really does sort of galvanize investors to make investment decisions from overseas because they see the pound starting to strengthen, and therefore it creates some urgency on their part. Now, if you do look at where the pound is, it's certainly strengthening against the US dollar. And that's quite interesting because usually when interest rates go down, currencies get weaker. But actually, the pound has got stronger to the USD. Why is that? Well, I think there's certainly this year with all the uncertainty in the US with tariffs, etc. Individuals, institutional investors have certainly been looking to, in part, divest from the US. Investors have been looking to invest into the Swiss franc, the GBP, the euro, etc., which have all benefited. Obviously, the tariff uncertainty has somewhat weakened the USD, and I think actually, Donald Trump is preferable to a weaker dollar because obviously that helps US exports. There are potential headwinds. Of course, if interest rates come off significantly in the UK, that may make the pound weaker. Of course, that will then help UK exports as well. So currencies are always an interesting thing. I mean, you shouldn't invest on the basis of currency into any assets. So I'll never sort of tell people from overseas to invest purely for currency gain. It's a byproduct. If it works in your favor, then fantastic. If you're looking to invest for the longer term, it almost becomes irrelevant. But it is something you need to pay attention to because it does obviously potentially impact timing for investment. So, David, I don't know if you want to add anything to that at all.
Yeah, I think you got the main points there. I mean, from what I've been reading, is that it's likely that we're going to see a GBP to US dollar at $1.40. Actually, interestingly, given we do euro investments as well, we could actually see euro to the dollar at $1.40 as well in the coming 6 to 9 months, which is a quite an interesting opportunity. So, yeah, we've definitely seen. The pound to the US dollar strengthen. Obviously, we're going to potentially see US interest rate cuts in the coming, couple of months. Most likely, US cut will come in. I don't think it will be in July. I think it will be in September, probably the next likely cut in the US, which could see the dollar weaken even further. So I think it'd be interesting to see where the US dollar GBP lies at the end of the year.
Yeah, yeah, agreed. I mean, the talk of the euro there that you mentioned, I mean, the euro is quite an interesting one. Obviously, interest rates in the eurozone have gone from 4% to 2% in a rapid time. If you look at currency wise, effectively, the euro is the reserve currency after the US dollar now. There's been a lot of euro appreciation to the USD this year as a result of that. I mean, we've seen that in our investments that we do in the eurozone. So no, I would agree with what you say, David, about your comments on the euro there to USD. So it's an interesting one. Um, okay, next slide, please. So now we're just going to sort of talk about where we're investing as a business, really. I think I shared with you, we're looking at increasing our work in the UK, the Eurozone, uh, and also into the Middle East, which I'll touch on in a second. Yeah, the UK is a big market for us. As I say, we've done over 100 projects, 1.5 billion pounds of investment over the years. We've got some quite unique niche opportunities. Stratford upon Avon, so effectively it's commuter belt into Birmingham, very short distance into Birmingham. It's a home of Shakespeare. Um, Me and David have been to all these projects. We've actually converted a small building into four very high here where you can literally walk to the waterside, walk into the town centre, the old cobbly streets, etc. It's a very picturesque location, but most importantly, it's a good investment. It's an area where you don't get much property come on for renting or buying. This was just an off-market opportunity to convert a building into four luxury apartments, and you're buying here at £295,000 and upwards with a 6% net yield. And with interest rates coming off, a net yield of 6% is certainly very appealing indeed. David, do you want to add anything to that?
Yeah, it's a lovely location. On the ground floor, you've got an art gallery. It's close to the water. As Grant mentioned, you've got the Royal Shakespeare Theatre, good schools close by. Actually, interestingly, it was voted the 13th happiest place to live in the UK. So it's an interesting fact for you, and only 2 hours
Yeah,
from London. So,
yeah.
yeah, it's a good opportunity.
Yeah, yeah, I certainly feel very happy living there. It's a nice location, nice restaurants, bars, etc. Beautiful surroundings, that's for sure. Next slide, please. Okay, another one me and David have visited up in Sheffield, very much in the centre of the UK. You get to London within a couple of hours, you get to Edinburgh within a couple of hours, hence the appeal for business. You've got lots of big corporates here, HSBC, Boeing, BBC. So this is a completed building, very high-end building, very close to Kelham Island, which is a sort of trendy, sort of up-and-coming area of Sheffield. This location is close to they've got probably the biggest Waitrose I've
Mm,
ever seen. The
mm,
significance of that is Waitrose do a tremendous amount of DD in terms of sort of emerging middle classes, etc. You know, demographics, and this is definitely a very high quality area with good transport links, lots of employees, and very good infrastructure.
mhm,
And you're buying from sort of about £160,000 with a guaranteed yield of 6% for 4 years. And we underwrite, we guarantee this, as I say, given the fact that we know the rental market's strong and we have a lot of units already rented out in this building. So we're happy to provide that guarantee.
mm.
Um, David, anything to add? Yeah.
Yeah, I mean, as you said, Grant, we visited this. I actually came from London to Sheffield. Took under 2 hours to get there, so very good connectivity. And when we saw the building, it's very high specification, good developer, good universities close by. You've got Chinatown as well, just the opposite road. And as you said about the Waitrose, very big Waitrose, around 4 minutes away from the site itself, and we all know the Waitrose effect, what it does to property.
Yeah, yeah, totally agree, David. Yeah, good points there. Okay, next slide, please. Okay, Birmingham. So Birmingham, slap bang in the centre of the UK. Again, if you look at those commuter times, it really does make it accessible. And of course, Birmingham has got the high-speed rail link going in over the next number of years and has been benefiting from some wonderful infrastructure projects. I mean, you've had the Commonwealth Games in Birmingham a couple of years ago, which really put it on the global stage. You've got science parks, you've got HSBC have moved in there. You've even got Goldman Sachs into Birmingham now, and lots of tech startups. You've got Digbeth, which is the sort of tech location. And then you've got the jewellery quarter, which is a very fashionable area where 40% of the UK jewellery industry is still in place. And this is where this project is here, 1940. Lots of history in this area. This sort of title of this building goes back to when this building was bought by a jeweler who moved some of their diamond industry from Antwerp into Birmingham, and they would cut diamonds here in these three buildings that we purchased. And as I say, there's a whole sector of jewelry industry nearby, and very trendy bars and restaurants, and it's walkable into the city centre of Birmingham. So they're all low-rise buildings. There's no high rises here. You can't build high rises. This is a developer we've worked with a number of times before. They build a high quality product. They don't have any financing on their buildings. They only use their own cash. So there's no issues in terms of cutting corners or anything. But sort of developing these grade two listed buildings is an art in itself, and you need good relationships with town planning, which is what this developer has, and they build a very, very high quality product as we've seen over the years.
Mm,
So we've discounted this unit because we're on the hook for buying anything we don't sell by completion. It's nearly ready for completion. So in effect, we will be buying this unit ourselves as a business quite soon now. So we're therefore, what we typically do is we'll discount it to fast forward a sale. Now, when we did launch this in this area, you're typically talking about £500 a square foot. With the discount, it goes down to 437 a square foot. So there's a very, very good buying opportunity here for someone who wants to invest in the Birmingham market. And then, of course, we will manage the property, we'll tenant it, and we'll do everything to help the look after the property long term.
mm.
David, do you want to add anything?
Yeah, I think you hit the key points there. But with the developer MVSM, who we worked with a number of times before, they're a top developer who they specialize in grade two listed buildings, which is takes a lot of effort, a lot of time, precision, etc., to get these buildings tip top condition. And they've done an incredible job with the previous project we did in Birmingham called Bishop and Fletcher. We had a number of clients who invested there, extremely happy with it. So very, very good developer who very high specification, the units. I'll also note, and I'll just flick onto the next slide as well, because it's the same developer as the Silversmiths, as you see here, is actually our lettings and management agency purchased a unit here in order to manage, because we have another number of projects in Birmingham. So the actual lettings and management company actually have an office here and they manage all the projects we have in Birmingham. So it's good to have that on your doorstep.
Agreed, David. That's absolutely right. So we've got the management absolutely on the ground there in real time. We can help with any issues. And that's very, very important when you're property investing. And as you quite rightly say, this is another project with that developer. I mean, they have the exposed brick walls, high ceilings, wooden floors. It is a labor of love for this developer in terms of the project they build. And you'll see on the map on the right here, where the location is and all the associated sort of big corporates nearby into Birmingham city centre. So the PwCs, KPMGs, Deloitte's, all the big corporates are very, very close by. So your tenant your catchment area is going to be sort of good net worth individuals who are looking to live in this locality. And as I say, this one we've discounted to £344 per square foot. So 10% discount, as I say, because of the fact that, again, we'll be purchasing this unit soon if it's not sold. So there's a good buying opportunity there for someone. Next slide, please. Okay, so we're just going to finish off with Germany and the new market of Dubai. As we shared, the Eurozone, Germany is undergoing somewhat of a renaissance, given the fact that, very much Germany, Europe is being reinventing itself as they look to sort of secure their own sort of defense and security. Under Chancellor Merz in Germany, he is releasing what we call the debt brake. So, in other words, he's going to invest more heavily in the economy. Germany's always been reluctant to do that, but they have the means to do it because they have very low debt levels compared to other European countries. So in effect, what we are seeing is obviously finance going into defense structure, but lots of money will be going into the infrastructure across Germany. So for example, last week, as an example, there's 500 million euros that is being committed to the German railway network. And as I say, that will positively impact the main cities in Germany. We've seen the German stock market go up about 20% this year as more confidence returns. We have seen lots more commercial investment coming in, institutional money, and that's normally a first sign before lots of retail investors come in.
Mm.
So we've done a lot of work in Germany over the years. We started investing there about 15 years ago. It's a great property market to invest in. It gives people a lot of confidence. You buy property as freehold. There are a lot of tax benefits. You hold property in Germany for 10 years. There's no capital gains tax. It's a very solid, secure buying process. It's a very solid, secure market. And also, as I say, there is certainly value in the euro because the euro has been very weak, but it's starting to pick up. And Germany is a very interesting city. Sorry, Berlin is a very interesting city in Germany because from the legacy of the fall of the Berlin Wall, it's always lagged behind major European cities, London, Paris, Madrid, etc., in terms of capital appreciation. But it continues to grow, attract a lot of investment as a big sort of tech build up in Berlin. And this developer is a developer we've worked with before. They build a good product. This is very much the sort of tech location of Berlin. It's in Friedrichshain, which is about a 15-minute trip into the center of the city. It reminds me of Hoxton or Shoreditch in London. In that location, you can pay up to sort of £1,200 a square foot. Here you're looking at about equivalent of £800 a square foot. So it's really a discount to the market. You've got the majority of expats who live in Berlin in this area, about 30% of expats. You've got big corporates like Amazon, the online retailer Zalando, and a number of other corporates. So the rental market will be super strong in this area. Do you want to add anything, David?
Yeah, I think a couple of key points I took from what you said there. Obviously, with earlier you mentioned about the ECB cutting interest rates to 2%. So that's a good opportunity. They've got obviously the European region's got their inflation under control, and they've been able to cut interest rates aggressively compared to the US and the UK. And they've also recently announced a 500 billion euro budget to fund new infrastructure projects around the country. Interestingly, with this developer, they've got 120 years experience, developed some great products, and this particular project completes March 2026, so they're ready very much off the ground, and we're only around 7, 8 months away from completion.
Yeah, correct, David. So that means there's not much developer risk, as we know, because
Correct.
it's
Yeah.
nearly built, and that's important to tell investors. And as I say, it's a developer we've worked with before who build a super product. So yeah, thanks for that. Next slide. Yeah, so just finishing the German story, Leipzig. Some of you may have heard of this city, some of you may not. It's on the east side of Germany. It's only about an hour from Berlin. It's the fastest growing city in Germany by population. A majority population under 40. It's got a very good connectivity in terms of railway network. It's got a big cargo airport. It's DHL's European hub. They build electric cars for Porsche, BMW here. You've got a whole series of startups. Some of the big companies like Ernst& Young, PwC, etc. here as well. There's a big university scene. It's a very attractive city, and people graduate, young people graduate, and they want to stay here. And this project we picked up last year, actually, when the market was really struggling. This is in the prime location of Leipzig, in West Leipzig, with a developer we worked 4 times before. We actually got a 10% discount off the pricing, which we wouldn't get now because of the way the market's turned around and the interest rates have come off. So it really is, again, a great chance for someone to get into a prime location close to the international schools, Royal Opera House, beautiful parks nearby, waterways, etc. In a very fast growing city in Germany. David.
Yeah, I mean, when we went there, we went to Leipzig. We took the train from Berlin. It literally took an hour and 5 minutes direct, straight into the city. This particular project, you're only a 20 minute odd minute walk to the city centre. And as Grant mentioned before, this developer we've worked with 4 times before, and they complete to a very good high specification. So we've only got a couple units left here, which complete at the end of the year.
Yep, yep, yep. All agreed, David. Thank you for that. Yeah, it's a super developer, 30 years established in Leipzig. Okay, so just to finish up with Dubai. It's our first project in the Middle East for quite a number of years. Why are we investing there now? Well, if you look at the market over the last 15 years, it's very much been quite erratic. It's been fast paced. It's been quite wild in terms of swings, ups and downs. What we see in the property market in Dubai now is much more of a maturing market. So why is that? So it's a very diversified economy. It used to be mainly oil and gas. Now it's oil and gas, it's large infrastructure projects, it's tech, it's media, it's financial services, it's legal. Um, and other things that are happening, you have a first class medical setup, you have very good international schools. Um, and you used to get people who would stay in Dubai just for a few years and then move on to somewhere else. Now people stay long term because of all the better infrastructure, medical schools, etc. And they buy their property and they stay there for quite a number of years. And then you throw in the fact of tax breaks, tax benefits, no capital gains tax, no income tax, etc. And it's very appealing for people to stay there. And as I say, the infrastructure will get better and better over the next 5 to 10 to 15 years with new railway lines planned, new airport planned, and that population growth is going to increase significantly from about 3.5 to 5.5 million by the year 2040.
Mm.
So, what typically drives property markets is population growth, yes. Wealth grows the property market, the right type of individuals moving in. And we've seen more millionaires move to Dubai in the last year than anywhere else globally. 6,700 have moved in. So if you imagine wealthy people moving in, that really is a catalyst for impacting very positively on property markets. So we've entered the market again. We're literally just about to launch into this market. We have found a value spot in Dubai. Property prices have gone up, of course, over the last 10 years, but the next 10 years, as I say, given the more and more individuals moving in, given that you buy property, you get a residency visa as well, given the fact of the growth of population, more and more job creation going on, we see a very healthy outlook for this market. And quite interestingly, we deal with hubs Hong Kong, Singapore. Those typically would be the sort of main places expats would go to. And now Dubai is very much amongst those two. And everyone I speak to knows someone who's going to Dubai, who's looking to move to Dubai, who's been in Dubai a number of years, etc. So we see the long-term sustainability of the market.
Mm.
David, any thoughts?
Yeah, I think you got the main points there. A couple of things I think it's worth mentioning are the developer is the fourth largest in Dubai, ninth largest in the world. So a very well established developer we're working with here. And finally, what you touched on about the visa, there's access here to the 10-year visa if you purchase property of 2 million dirham or more, which is, I think, quite key to this investment.
Yeah, 2 million dirhams is about 550,000 US dollars.
Yeah.
It's about 425,000 pounds. And you can mortgage that, so it doesn't have to be a cash investment. So actually, it makes it very attractive as well. If people are looking for residency visa, we talk about, Portuguese golden visa, other visa options, but the Dubai market offers an opportunity to have that visa access for the individual and their family, and it will be renewed every 10 years. Um,